Hey everyone, welcome to another episode of The Remote Real Estate Investor. I'm Michael Albom, and today I'm joined by Dana Dunford, co-founder and CEO of Hemlane Property Management. And today Dana's going to be talking to us about the state of the economy and some things that investors should be aware of and thinking about as we move forward in today's market. So let's get into it. Dana Dunford, welcome back again to The Remote Real Estate Investor. Thanks for coming on and hanging out with me.
Great. Thanks for having me again, Michael.
Oh my gosh, it is such a pleasure. You are a great friend of the pod, a great friend of Roofstock. For those who might not be familiar with you, give us the quick and dirty background, who you are, and background on yourself.
Yeah, so I'm Dana Dunford. I'm here in San Francisco, so just right across the bridge from Roofstock. I have been in technology for, gosh, now we're going on 18 years. So I'm a tech veteran, which we'll be talking about today, which I'm excited about. And on top of that, I'm in property management. So we're a tech platform for property management and partner of Roofstocks. And we've seen what has been going on since Q1, the market softening, things changing in technology. So I think this is going to be a great call because both Roofstock and Hemlane have seen it firsthand. And hopefully this gives some insight into what the upcoming year is going to look like for all real estate investors out there.
Totally. And just to give some people some additional color, you are CEO, co-founder of Hemlane, and you just did your
Mhm.
Series A. What was it, Q3 of 2021 or Q4 of 2021?
Q4, so we raised at the perfect timing. Those who are not in venture and the tech world of Silicon Valley, we couldn't have timed it better. Right now, and we'll talk about this today, right now the market is really softening. There's just less capital going into startups. We can't say this was people were already predicting this. So back in Q3 and Q4, venture capitalists were already saying, ooh, there's a lot of money pouring into this. Valuations are really high. And some had already started pulling back. But it wasn't until what happened in the public markets where, trillions of dollars were taken out of these SaaS companies' valuations or overall the market cap, that suddenly the venture world trickled down and people really started to pull back capital. So yeah, we raised back then. Roofstock, when was your guys' last raise? Because you guys are at a later stage, and so obviously also impacted by this, and quite potentially more significantly than us.
I think we got our term sheet squared away in Q4 as well. So right around that same perfect timing with money
Yeah.
getting wired in and coming in Q1.
Yeah, perfect. So you guys will be able to weather this storm that we're going to be talking about soon here.
Yep, absolutely. I'm thinking so. Okay, so let's talk about how did we get here? Because you're mentioning that trillions of dollars have been essentially taken off the table in terms of market cap. But for those people that aren't familiar with the space, that haven't maybe been following along as closely, where are we today? And can you give us some insight and background as to how you think we got here?
Yeah. So first of all, I believe most people on this podcast today listening are real estate investors, and so all of you hopefully got in when interest rates were super low, just artificially low, right? We've never seen interest rates below 3% for so long, and one that was fantastic for real estate, right? You could get a rental properties at afford a higher price because your interest rate is much lower, your loan. And then for startups and for companies, money was much more free. It was much more flowing. What we ended up seeing happen, which most people predicted this would happen, but no one knew when. Or at least I haven't heard of any economists who knew this was going to happen exactly in March. But we started seeing inflation go through the roof, 8.6%. And it's been consistent where we have seen the inflation rate really, really high. And so the only way for the Fed to essentially combat that was obviously to increase interest rates, which we are all seeing now. We're all seeing in our real estate itself. Doesn't mean there aren't great deals out there. So, Michael, I do want us to talk about that because I still think there's great deals out there that you guys have
Yeah.
on the platform, and now could be a really good time to buy. So, don't let that taint your decision of whether or not you should go into real estate. But with that, as you know, when the Fed raises interest rates, consumer spending just goes down. Inevitably, people will spend less, and also things are more expensive. And so once you have that happen, the stock market's inversely correlated to interest rates. And so once interest rates went up, there was a correction in the stock market. Why it affects us on the private company side so much is Roofstock and Hemlane are both considered growth companies. And what happened was essentially in the public market, so any public company, there's basically two different types. There's growth, just like us, companies like Roofstock that have gone public. And then there are value companies, and the value companies are much more stable. They're based on their cash flow. They're typically larger, older companies, and their price is based on their sales. So their price is relatively low relative to sales. And companies like that are like Bank of America, if you think about it, NRG, like gas companies, like very stable, steady businesses where you're not going to
Your
see,
blue chip companies.
yeah, your blue chip companies where you're not going to see, 500% growth year over year. But what ends up happening is when the interest rates go up like that and stocks go down, the ones that get devalued the most are the growth stage companies. And the growth stage companies are companies like Roofstock and Hemlane that are public. And so what we basically saw happen was this huge, huge cut in market cap in the public markets. And so for SaaS companies, software as a service, where you go, you pay a subscription every month to use a service, the market cap got cut by $1 trillion from November of 2021 until today. And so what that did was essentially these companies thought they were worth a lot more. And, some of them, like the Stripes of the world and the Snowflakes, had these really high revenue multiples. And suddenly those just deteriorated. And the multiple based of what their valuation is versus their revenue went down, and that essentially trickled down to private companies like us as well. And so now when a company goes out to raise capital in Q1, Q2, primarily now it's even worse. And what we're foreseeing in Q3 is that you might have had a 10x revenue multiple. So your valuation is 10x what your revenue is. That's how it used to be. Now you go out to venture capitalist and they're like, great, you're worth 3x or 5x, so much lower valuation. And so what they're expecting is a lot of down rounds, a lot of startups saying, if I can, let me just hold on to my cash, let me cut my burn, let me try to raise later and better times. And all of this impacts the economy because it was the public markets that were hit, and now it's also the private companies where we are in Silicon Valley. And I do think this trickles a bit to real estate. It's a different type of market correction than we saw in 2008. In 2008, it was housing, right, and the mortgage crisis. Today, I think this is a lot more like the dot-com bubble. This is very similar to the dot-com bubble of these really high tech valuations that need to be corrected. And so when you think about purchasing real estate, I actually think that's why Roofstock is such a fantastic place to go, because you're getting out of the tech scene. You're going to other markets and purchasing there.
It's so interesting. But Dana, so I'm curious. We talk so often about in real estate that the price is only a factor, or it's only important if you're doing something with the property, if you're buying, selling, refinancing, because otherwise you're just having a cash flow, and that often is independent of what the value is of the company, or
Yep,
excuse me, of the property.
of the
So
property.
why does that matter for companies? Like the fact that the company is now worth less, unless they're trying to do something, buy, sell, or refinance, or raise raise capital. Like, why does that matter?
So it doesn't matter for Roofstock and it doesn't matter for Hemlane because we just raised. We have enough capital to weather this storm. But imagine a company that raised and they had a, let's just give the case of like the Stripes of the world, 100x multiple. And let's just say it's a private
Okay.
company with a 100x multiple. And now they're going back out and they're now getting a 10x multiple. They could have what we call a down round, where suddenly they are worth less than they were before. And that gives a lot less confidence. One, the company itself, right? The amount that you're giving up as a founder, as an employee, as an existing investor is a lot more just to get in the same amount of capital you wanted to historically. And so what you're seeing is these companies really, really tighten the ship and just say, okay, we are going to stop hiring as many people. We're really going to look at our expenses. And that means there's not more money pouring in to, hiring 100 people every week. They're suddenly going back and thinking about who are these strategic hires we really need? Should we be letting go? You've seen the massive tech layoffs where it's, 20% of the workforce. And now suddenly they're really tightening their books because cash is king right now. You want to hold on to that cash because the last thing you want to do is go out and have a lower valuation.
Yeah. Okay. Well, that makes sense. And so, talk to us a little bit about why this is affecting real estate investors, or why real estate investors should even care about this that's going on.
Yeah, so I always think there's a huge opportunity when there's like the Warren Buffett quote, right? Be fearful when others are greedy, and be greedy when others are fearful. I think right now everyone's scared, and there's a lot of real estate investors. Like we actually just did a survey at Hemlane where a majority were saying we're not going to purchase in the next 12 months because interest rates have gone up. We should have gotten in a year ago. Well, the best time to get into real estate was 10 years ago, and the next best time is today. I think there's going to be a lot of great deals out there. I think that while others are tightening up, other investors are scared, this is the time for you to be really aggressive. I mean, still look at your pro forma and follow your numbers, but you'll be able to find some great deals out there.
I've heard a lot of sentiment around you can always change your interest rate, but you can never change your purchase price. So if someone is getting into a deal today at an interest rate that's a little bit higher than they're comfortable with, but they anticipate interest rates to come down at some point down the road, what are your thoughts there?
Yeah, you can always refinance. I mean, don't do a deal hoping that interest rates go down and you can refinance. So don't fudge the numbers on your spreadsheet. This is why,
I was hoping that's what you were going to say.
yeah, like this is, I mean, this is why I'm more conservative than most. In every property purchase has had a fixed rate. I don't do adjustable, but I can refinance, right? So I can always refinance, but I want to know what I'm getting into. So when you do your pro forma, do it with whatever the interest rate is now, and consider it a huge advantage in just like increased cash flow if you can refinance in the future. Will interest rates go back to this like artificially low rate that we saw over the past 5 years? Maybe not. But I don't think that is a reason not to purchase now. You do your numbers and you look at it. Just because you might say property values are really high, interest rates are going up, now's not a good time to buy. That's just laziness. Like, honestly, that's just you being lazy and not wanting to do the work. There's always great deals out there. You just have to do the work, find them, look at the numbers, and say, even with this increased interest rate, it's still a great deal. I'm still cash flowing. I've got a great cap rate. And you can go ahead and purchase. So I don't think of this as a time really to change your decisions on real estate. And part of that has to do with, I think, some markets will soften. Some markets may remain flat for a while, but that doesn't mean that you're not getting the cash flow and having a great investment that, by the way, with inflation where it is, and if it continues, having an asset where the value goes up with inflation. So I still think now is a great time to purchase real estate, and you might be able to get some fantastic deals as other investors are pulling out. You can really, really go in and get those great deals.
Love it. And Dana, I'm curious if, because we've seen prices go through the roof and interest rates have also gone up significantly, there might be a bit of a lead lag measure until we see prices come down. So in in terms of looking for different markets, I mean, are you targeting markets that are continuing to grow, or are you targeting markets that maybe are seeing some of that softening in terms of pricing?
So for us, we go where the real estate investors are. So if there's a real estate investor there, right, we're gonna do the property management for them. I think when you're thinking about the lag, that is definitely true. I've heard this with other real estate investors. I've seen it myself, where you see a price and with interest rates up, the seller puts one price out there because that's what it was 2 weeks ago, and suddenly it's
Right.
not worth that much. It's worth like 10%, 20% less. But it's actually really good to put yourself into the position of the seller and of the real estate agent, because you can actually get some really, really good deals off of that. And what I mean by it is real estate investors have always told historically, have told their buyers in the past couple of years, if your property is on market for over 2 weeks, people might think there's something wrong with it. And
Right.
so, we're going to ask for offers on X date, right? Like X date in 2 weeks, or maybe we'll do 1 week. We're going to ask for offers. Well, if they've mispriced the property, you might be able to go in and you don't know this, but you might be the only offer because they priced it way too high, because they priced it from a purchase price from 2 weeks ago. And now that has suddenly changed. Like the market changes every 2 weeks. It really is, and you could go in and get a great deal. And so I think from that perspective, there are still fantastic deals out there, but you have to be patient. And some of it will be that luck where you get the right deal no one else has gone into, and you can go ahead and purchase it. So if you put yourself in the other shoes, you might see that. You also see a lot of people. Why I don't think it's like 2008 and 2009 is people have a lot more equity in their properties because one, values have gone up. And then two, the interest rates were really low. People could afford more, put more money in. The market was booming. And so what we're seeing is that more people have equity in them. And at some point, it's emotional for someone. They're like, I just want to get rid of this asset because I'm going to go buy another one, or I just really want to move out of the city and move somewhere else. And to them, maybe 20 to 50 to $70,000 is not a lot, depending on what it is, but that is a lot to you, and that changes the numbers on your spreadsheet significantly. And so, I mean, with that purchase price, obviously that matters, but just because the price is out on the market for a property doesn't mean that's the price it's going to sell for. And so it would be a really good time to go out and experiment with that. You will know your market better than anyone else, whatever market you're in, because it will take you bidding on like five properties, and maybe people will laugh at you. Like your first one, you go like 20% under and they laugh at you, but maybe you get lucky on the fifth one and you get a great deal. But yeah, just follow the numbers in your spreadsheet. Don't have a purchase price that doesn't make sense and you're not cash flowing, or don't change the interest rate hoping that it will go down to that amount.
Yeah, that makes total sense. And speaking of spreadsheet numbers, are you seeing a lot of your investor clients that you work with adjusting their expectations around cash on cash returns now that prices and interest rates are up?
Um, so not really. I think most investors, like most of the savvy ones we work with is sort of two different types of customers. Those who had properties just handed to them and they actually never did the analysis, like hand downs from parents and things like that. And then others,
Accidental
accidental,
landlords.
yes. And then others who are very strategic real estate investors. And what we have found with them is they have the capital, and they might be with inflation, to your point, Michael, being like, oh, maybe I should just go buy something because the dollar today is worth less tomorrow. But no, I actually think most real estate investors are still saying, uh, this is the deal that I got historically. I want to get something like that. And so they're not changing those expectations on cash return, but they might be going somewhere else. So they go to Roofstock and they say, okay, couldn't find this property, in my backyard, but on Roofstock, they do have the cash on cash return that I'm targeting. And so I do think they're not changing their expectations, but they are going out and finding alternative ways to get the numbers they need. There's one case, Michael, where I find people change their expectations, and it's first time real estate investors to just get their
Okay.
foot in the door. And I'm actually okay with that. I think that there's too many people who, and for anyone who's listening to this, who doesn't have a real estate investment, you kind of sit there and you kind of fantasize about getting one. And then you put so much like anxiety into getting your first property. And once you have your first, you're like, oh, okay, that's what I got. Here's what it is. And it makes it easier where then you can go and purchase more properties and more properties, and you know what you're looking for and you know what the return was, and you have this process set up. But the first one is really difficult to get into. So I find that those people today are changing their expectations for certain metrics just to get into the market before it's too late. Interest rates go up more, or, they're kind of kicking themselves that they didn't get in, 4 years ago, 5 years ago. So I only think it's first time real estate investors where that's happening. And I'm actually okay with that, because I think if you can get more people into real estate investing and more people to just get their foot in the door, you're going to learn so much off of that first property that then you're going to say, okay, this was my cap rate for my first property. My next one, I have to at least have that or better. And you kind of improve. It's kind of like dating. You don't date someone who's great and then like the next person is like a downgrade. You kind of have this standard and you're like, I can only go up from there. It's the same exact thing with real estate investing. So I really think it's only first time home buyers where that happens, or real estate investors for rental properties.
Yep. I think that makes tons of sense. It's something that I hear all the time. It's, oh, Michael, I'm trying to get my first deal done. It has to be amazing. And, I want it to be a grand slam. Like, don't worry about the grand slams. Let's practice getting on base first. And then you'll know how to swing for a grand slam.
Exactly. And it makes it a lot easier when you have one property in that area. You know your market a bit more, and then you can kind of purchase some more around it. Yeah.
Yep. Yeah, I think that's totally right. And so, Dana, we're kind of at this like crossroads where we're talking about some investors are pressing pause on their acquisitions. And then this whole other cohort of investors are like, oh, crap, I got to get into the market before interest rates go up further, before prices go up further. So it does feel like there's this pressure to buy, or there's frenzy to buy on the one hand. And then there's this whole other group that's, again, kind of taking a step back and saying, let's wait and see what happens. How do you square those two?
Well, to me, I'm like a pretty unemotional real estate investor. And I feel like for anyone, whatever segment you fall into, you still have to go back to the numbers and see what makes sense. And so, I mean, is there a right way to go? I think people who are not going out and they're using this as an excuse not to purchase properties are just being lazy, honestly. And for those who are out there saying, I got to get in and get my next deal, I think they're almost too emotional, where they might go in and change the numbers to your point of saying like, oh, it's not, my last deal was better than this, but I just need to get my foot in the door. Maybe that's not the right approach to have. It's, hey, there's going to be a deal out there. I might have to be a little bit more patient during this, for the next 3 to 6 months. I have to be patient. I have to understand what's going on. But yeah, I just kind of go back to the numbers. I think in both cases, they're taking emotion and what's happening in the market and using that, like the macro for the micro. And instead of saying, you know what, I know what is a good deal. Here's what it looks like on paper. Let me continue to go search until I find that. And it might take you a little bit longer to find it, or you might find a process like, oh, wow, I can, go 20% under and get lucky on a deal off of this, whatever the home price is. I could, undercut them and give them an offer, and maybe they'll take it to get that great deal. But I think both categories are bad. I think someone who says I have to get my foot in the door before interest rates go up is emotional. I think someone who says there are no great deals out there are just lazy. And so I kind of fall somewhere in between of saying, yeah, just be financially prudent as you always should be with your real estate investments. Know your market, know what numbers you need, and make sure you're a little bit more conservative. Like I know a couple investors with adjustable rate mortgages that did them, back when interest rates were really low. And I bet they feel pretty stupid right now. So
We won't
yeah,
name
no, we're not going
names.
to name names here. Yeah.
Well, I'd be very interested to meet the emotionally lazy person because it sounds like those are two opposite ends of the spectrum, but we'll
Yeah.
have to see. Okay, and last thing that I want to ask you about is around expectations. If someone is newer to the investment space, they're maybe looking to get their first deal done. Everyone around them, their sister, their brother, aunts, uncles in this market are making 10% cash on cash. Let's
Yeah.
pick a number. Nice round number, 10%. And they're like, their expectation was 15%.
Okay. Yeah.
For whatever reason, that's what makes them tick. That's what gets them excited about an investment. Everyone around them is making 10%. So how should investors be thinking about not looking at other people and just focusing on what's good for them, but also not being blind and naive to what a market is really able to produce in terms of a
Yeah.
return? In other words, like I want someone to be excited about the returns that they're getting, but I also want them to be
Yeah.
realistic. How do you how do you throttle
Yeah.
that?
Um, so the biggest thing I would say to throttle that is most likely you've sort of selected a market because you've looked at,
Right.
okay, where is, and I mean, Roofstock does this for you, and you guys, I think, have some great shows from like every single market of why you guys are looking at a certain market. So that helps. But you
Thanks.
as a real estate investor are going to say, where's population growth? And why? Like, is more industry going there? Like maybe an Amazon facility was just put into place. Does it have Fed, eds, and med? Like, is it stable, even recession proof, especially now? So you kind of go through and figure out, why am I excited about this market? And you just start there. And like, don't forget about I need 15% cash on cash return. Like, let's just forget about all of that and just go through looking at macro. And now we're kind of going to micro to like city level. Why do I think this is going to be a good market in 5 to 10 years? Because you're going to hold on to these properties and purchase more, right? Do that first. Then you say, okay, this is my market. Then what you're going to do is for 2 to 3 months, you're going to look at all the deals there. Go on Roofstock. I think you can set up alerts because I have those that go to my email that essentially like tell you here's a new property in that market. Great, purchase. You're going to go through and you might the first couple of properties say, you know what, those don't really hit my cash on cash return expectations. But now you're starting to know your market and you're going to see a trend. Are they going up? Are they going down? And you can look at that over time to make an unemotional decision that is based on data. I think that is the most important thing to do. When someone gets in this frenzy of, I need this cash on cash return, shoot, I'm not going to get it, so I'm just going to slash it. And I'm going to say now I need, 7 or 8%. And you're just becoming emotional. But if you go through, look at the numbers and you say, okay, great, I wanted 15%. My friends are getting 10%. And you change those expectations. And suddenly you say, okay, I made this decision and here's my cash on cash return. But I know at that time that was the best I could do because I looked at the data. Then suddenly you never go back and wish you had done it differently, because you have something that is not emotional to back you up. And don't compare yourself to other real estate investors. I've seen real estate investors in the past 4 to 5 years who've been super successful who are super stupid. And the reason they were successful, and I hate to say that, but like there's so many people out there because basically it was free money. Like there was so much investment. There was so much easy money from investors that I saw way too many people
Mm-hmm.
also going into real estate. A lot of actually on the fix and flip side that just got lucky because, yeah, money was basically free to do a fix and flip. And the home prices were going up astronomically, and they feel like they're the smartest people in the room. Well, maybe they were at that time, but like give it 2 to 3 months, maybe 6 months, and the story might change. And so that's where I think it's hard at like one point in time, if you're just getting started, to compare yourself to those around you. I don't think you should do that. I think you should just be financially prudent and make sure that you're not overextending yourself, and you know your market, and you know why you made the decision you did, and it's all based off those numbers. And it's based off the numbers, but also you need to know the market. Like you need to know, you guys have neighborhood scores and ratings, that kind of stuff of like, here's why I only invest in neighborhoods that have 3 stars or greater, or whatever it may be. Like write all of this stuff out and take a really methodical approach to your assets, your real estate investing. And I don't think you'll regret it. Like, I don't think you're going to go back and say, oh, I really wish I would have gotten the 15% I targeted.
I think that is like spot on.
Yeah.
Dana, thank you so much. And if you missed it, if you missed any part of that, go back, rewind the last 3 minutes and listen to that again, because I think that's a lot of gold in there. Dana, this was super fun as always. If people want to reach out more, find out more about you or Hemlane, where's the best place for them to do that?
Yeah, you can go onto Roofstock when you purchase a property. Hemlane will be listed as a property manager. So go ahead and do that. You can also go to hemlane.com. And then my email is dana@hemlane.com. So I love hearing from people.
Awesome. Well, thank you again, and very much looking forward to having you on again, I'm sure. Take care, and we'll chat soon.
Great. Yeah, I'm excited in 6 months for us to see if we stand corrected on what's going on in the market.
I know it'll be very interesting. We'll have to keep close tabs on it.
Great. Thanks so much for having me.
Hey, you got it, Dana. Take care. Okay, everyone. And that was our episode. A big thank you to Dana for coming on as always. Big friend of the pod, as we were saying at the beginning of the show. As always, if you liked the episode, we'd love to hear from you all with a rating and review. And we look forward to seeing you on the next one. Happy investing.